Hello everyone. Today we'll be going over accounts 2021 May June paper 2-1 and we'll be solving question number 1 in this video. So the total marks for the structured paper 2 is 90 marks and we're also given the time limit of 90 minutes. And since this first question is of 30 marks, we will be attempting to solve this question under 30 minutes. Alright, let's get started. So Suin owns a small retail business. She has not maintained full accounting records. So we're talking about a small business here and which chooses not to maintain full accounting records. Alright, so we need to state two reasons why the owner of a small business may decide not to maintain full accounting records. So the main thing to remember here is that we're considering a small business. So maybe the business owner may not have enough funds to afford the services of an accountant or accounting software. That's why she chooses not to maintain full accounting records. Or maybe she is content with the information provided by her current accounting records, right? So we already have the two reasons. Let's write it down. The first reason was that maybe not have enough funds to afford the services of an accountant or accounting software. Alright, then the second reason was that maybe she is content with the information provided. So content with the information provided by her current accounting records. If she has no further use for full accounting records, then she might not choose to maintain those records as well, right? Alright, this completes the first part of the question. Now let's move on. Suin has been informed that the accounting concepts of matching and prudence must be followed when preparing financial statements. Now we need to explain how these accounting concepts are applied when a business prepares financial statements. Firstly, we'll explain the matching concept. So under a matching concept, an expense should be reported in the same period in which the corresponding revenue is earned, considering accrual accounting. Here, accrual accounting means that we do not look at the amounts received or paid. We also consider the receivables and payables. It is similar to the accounting concept which we follow under making an income statement, because while making an income statement, we record all the revenues and expenses corresponding to one financial year, regardless of whether it is paid or yet to be paid, and received or yet to be received. All right, let's write that down. So an expense should be reported in the same period in which the corresponding revenue is earned, considering accrual accounting. All right, and here the accrual accounting means irrespective of amounts received or paid. So the second accounting concept that we need to explain is the prudence concept. Prudence concept essentially ensures that the company is not overvalued by preventing the income and assets from being overstated. So we do not really overstate any of the income and assets and liabilities from being understated, and we do not show less liability than what are supposed to be owing to other people or other businesses by realizing the losses to be realized as soon as they are anticipated. And if we're talking about losses, we already talked about income, right? We do not overstate the income, but in case of losses, as soon as we anticipate it, which means that okay, the loss might happen in the near future, then we realize it, which means that we record those anticipated losses as well. All right, let's write that down. So prudence concept ensures that the company is not overvalued by preventing the income and assets from being overstated and liabilities from being understated by realizing the losses to be realized as soon as they are anticipated. So one example for anticipated loss may be a provision for doubtful debts, right? It might happen in the near future, so we already realized that loss at today's date. All right, this completes the second part. Let's move on to the third one. Okay, we're given additional information. So we're given the opening business's assets and liabilities. Then we're given the summary of bank statements. We're also given the cash account for the year ended 31st July 2020. And we're given some information about goods returned to suppliers and that all sales were made on a cash basis. And we're also given information regarding payables, inventory, and assets at the closing date, which is 31st July 2020. Let's look at what we are required to do. Now we need to calculate total purchases for the year ended 31st July 2020. All right, let's look back at the given information. So here we can see that we're given the trade payables, right? Trade payables is something that relates to purchases made but yet to be paid. So we need this information in order to calculate the total purchase, right? Then we can see here that we're given cash purchases under the cash account for the year ended 31st July 2020. We're also going to need that information. Then, okay, what else do we need? We need the trade payables opening balance. So that's given as well. And then we're also given that suppliers were owed. So this is a payables. This is trade payables as well. All right, I think we can do with these information. So let's make a statement first, right? So in order to calculate the total purchase, what we're going to do is, that's the amount. We will be starting from the closing trade payables. And we can see that there is no sign, which means that we will be adding this amount. So why are we adding the closing trade payables is because if we purchase a good from a supplier on credit, right, and we haven't paid it yet, so the amount is yet to be paid, then that amount will be included in the closing trade payables, which means that the amount for the closing trade payables will be under the amount of the total purchase for the year, right? That's why we're adding this amount. Then we will subtract the opening trade payables. So less opening trade payables. Now there might be a question, why are we adding the closing trade payables but subtracting the opening trade payables? Because we're only going to calculate the total purchases for the year, which means that we're only considering the goods that we purchased in this particular financial year, right? But the opening trade payables amount correlates to the purchases made before this financial year. So that will be the purchase relating to the year ended 31st July 2019, which is not considered purchases under this particular year. That's why we will be subtracting this amount. Next, we'll be adding the cash purchases. So this cash purchase, it's quite self-explanatory really, because this is the purchase made for the year ended 31st July 2020, right? That's why we're adding this amount. Then we also made credit purchases during this year. So we're also going to add that amount. And this will give us the total purchases. Now we just need to look for the corresponding amounts of these four headings. So in order to find the amount for closing trade payables, we'll have to look under the information given at the end of the year, right? So that's going to be at 31st July 2020, we're given that suppliers were owed 4,560. So this amount is still yet to be paid, which falls under closing trade payables. So that's the amount, 4,560. Now, for opening trade payables, we have to look for the opening date information, which is given at the first, right? On 1st August 2019, that's the opening date. And we're given the trade payables of 3,970. So we need to subtract this amount. So that's 3,970. I'm going to keep that in a bracket, which indicates that this amount should be subtracted. Now for the cash purchase, it is mentioned under the cash account, right? And the purchases is of 1,320. So we need to add this amount. So that's 1,320. Now for the credit purchase, that's given in the summary of bank statements. We're given that trade payables after deducting 2.5% cash discounts. So trade payables means that these are payments made after credit purchase, right? But this amount correlates to the amount after deducting 2.5% cash discount. All right, so if the total purchase was X, then the 2.5% of this amount is the cash discount, right? Which means that the remaining percentage, which is of 97.5%. So 97.5% of X is the trade payables amount, which is given right here. But we need to include the total purchase made, because that's the total purchase, but then we received a discount of 2.5%, which we include as an income at the other income section in the income statement, right? But while including the purchases amount, we need to include the total amount of goods that we purchased, which is going to be X, right? So we only have 97.5% of X, but we do not have the actual value for X, so we need to solve for it. So what we know is that 97.5% of X is 46,800, right? Then if we solve this equation, that's going to be X into 97.5 by 100 is going to be 46,800. That just means that X is going to be 46,800 into 100 divided by 97.5, which gives the total amount X, which is really the credit purchase, right? So the credit purchase is just going to be 48,000. All right, so that's the total amount, including the discount as well as the trade payables. But what we're also given is that goods had been returned to suppliers. So this is goods returned, right? Which amounts to 1280. So in order for goods to be returned, we need to purchase that goods in the first place, right? So which means that goods worth 1,280 was purchased initially, but then that goods was returned again. So we have to include this amount of 1,280 under the credit purchase. All right, so I'm going to write it down here. So credit purchase, there are going to be three factors. So the first one is payments made to trade payables plus the goods returned plus the discount received. Or we can include these two factors as one, because the payments to trade payables was 97.5% of the total amount, which we figured to be 48,000, and then the discount received is 2.5% of the total amount, which is again 48,000. So we can just include the amount 48,000 for these two headings, and then goods returned was given in the information to be 1,280. So this gives us the total credit purchase of 49,280, which we will be going to add under this statement. So that's 49,280. Now, in order to find the total purchases, we just need to calculate these amounts. So that's going to be 4,560 minus 3,970 plus 1,320 plus 49,280, which gives the total amount to be 51,190. That's the total purchase. So this completes the third part. Let's move on to the fourth one. So we need to prepare the income statement for the year ended 31st July 2020. We're also given a section to do all of these workings. And alright, we're already given the format. So let's start with sales. So I'm just going to write down the format first till gross profit, and then we'll include the amounts. So the first one is going to be net sales. Then we have to subtract cost of goods sold. So I'll write the headings under cost of goods sold right here. So the first one is going to be opening inventory. Then we add purchases. Then we subtract purchases returns. Then we again add carriage inwards. And then we subtract closing inventory. So this is just the format for income statement. And after we subtract the cost of goods sold from net sales, we obtain gross profit. All right, let's just include the amounts for these headings first. So let's look at sales. So sales, all right, we were given the information that all sales were made on a cash basis. So there are no credit sales, right? And all the cash transactions is given under the cash account. So we're given cash sales right here, which amounts to 96,000. So that's just going to be the amount for net sales under income statement. Let's write that down. So this is going to be 96,000. Now we need to look for opening inventory, which will be given under the opening dates information. So we're given inventory right here, which amounts to 11,440. Let's write that down. That's 11,440. We need to add purchases. So purchase, we just figured the amount right here. So that's going to be 51,190. Let's write that down. Then we need to subtract purchases returns, which is also included right here. So that's goods returned, right? Which amounts to 1,280. So we need to subtract this amount. So I'm going to put it under a bracket. So that's 1,280. Then we need to include carriage inwards, which will be given in the information section. All right, we're given right here. So that's carriage inwards. It amounts to 610. So we need to include that amount as well. That's 610. Now finally, we need to subtract the closing inventory. So closing inventory is going to be given at the information for the closing date. That's right here, and it amounts to 18,720. Let's include that. So that's going to be 18,720. Since we're subtracting this amount, this should be written with a bracket. Now we need to find the total cost of goods sold. So we just need to calculate all these 5 amounts. So that's going to be 11,440 plus 51,190 minus 1,280 plus 610 minus 18,720, which gives the cost of goods sold to be 43,240. And since we need to subtract this amount from net sales, I'm going to put this amount in a bracket as well. Now, in order to figure out the gross profit, we just need to subtract 43,240 from 96,000, which gives gross profit to be 52,760. All right, so this completes the first part. Now we need to add any other sources of income. So add other income. All right, let's look for anything that could give a rise to other sources of income. So we can just look at the summary of bank statements and receipts. So that's cash sales, right? We already included the sales, but another receipt is from proceeds from the sale of equipment. So net book value was 490, but we got the amount of 550, which means that we're getting higher value than we anticipated, which results in the profit. So profit is just going to be the difference between the amount actually received and the net book value, which is going to be 550 minus 490, which is going to be 60. So that's a profit on sale of equipment, which we can consider to be an income, right? So let's write that down. So this is going to be profit from sale of equipment. So that's going to be 60. I did the calculations on the question paper itself, but make sure you guys do the calculations under the workings heading. So we can just write it as profit on sale of equipment. That's 550 minus 490, which gave us the amount of 60. All right, let's look for any other sources of income. We don't have any other under the summary of bank statements. I don't think we have any under the cash account for the year as well. Oh, all right, we had cash discounts of 2.5%, right? And the total amount was 48,000. So let's just figure out the cash discount. So cash discount received. So that's going to be 2.5% of 48,000. So this is going to be 2.5 by 100 into 48,000, which gives the total discount received to be 1,200. So we need to include this amount under the other income section because discount received is treated as an income. So that's going to be discount received of 1,200. I don't think there's any other income, so this is going to be it. So the total income is just going to be 60 plus 1,200, which gives 1,260. Now we need to subtract all of the overheads. All right, let's look for the overheads now. So the first one is going to be shop rent. So that's 3,580. Let's look for things that we need to adjust. So that's going to be the opening dates or the closing dates information. For opening date, we have shop rent right here. which is payable. So that's going to be opening payable amount of 510. So we need to adjust this amount. Let's do that under the working section. So we are doing it for shop rent. We were given the original payment to be 3,580, and we were also given that the payables at the opening date was 510, which means that that amount was yet to be paid. And this paid amount includes that amount of 510, but since that amount of 510 is the shop rent for the previous year, we do not include it under the current year's income statement, so we need to subtract that amount of 510, which gives the total shop rent to be included as 3,070. Let's include that. So shop rent is going to be 3,070. Let's look for another overhead. So that's going to be general expenses. It amounts to 16,810. For the opening date, we do not have any information relating to general expenses. Let's look at the closing date. We again do not have any information, so we can just include the amount as it is, 16,810. So that's under general expenses. And the amount is 16,810. Let's look for another overhead. That's insurance right here. So insurance, the amount is 2,950, but we're given the information at the opening date of 290. That's other receivables, so yet to receive amount. So we need to adjust it. Let's do that under the working section. So we will be working for insurance. The amount that we paid for this year is given to be 2,950, and amount yet to be received at the opening date was 290, which means that we have not received it yet, but we received it in the current year. We assume that, right? So we need to add the amount 290, which gives the total insurance to be 3,240. That's the amount we should be including in the overhead section. So that's going to be insurance with the amount 3,240. Let's look for any other overheads. Summary of bank statements, we've included all of the overheads, so we can just completely ignore it. Then under cash account, we're given wages. So this is paid, 15,430. We do not have any other adjustments, so we can just write the amount as it is. So that's going to be wages of 15,430. Now, okay, for the final thing, I think a lot of the students tend to miss that part, which is the equipment, fittings and equipment. So we are given the opening balance of 18,500, right? And we are given the closing balance of 15,860. And I don't think there's any other. All right, we're also given that we sold the equipment, right, of net book value 490. So we need to figure out the depreciation for the year, right? So we will be using these three information and then try and figure out the depreciation amount. We'll do that under the working section. All right, so okay, I'll just write the statement format. So we always include the opening balance for any asset, right? And then we add any new additions, right? And then we subtract any disposals. And then we subtract the depreciation charge for the year. And this gives us the total closing balance of any assets. All right, so we're just going to solve this in the form of an equation, right? So the opening balance we were given to be 18,500, right? Then there were no new additions, and disposals we dispose of an equipment with the net book value of 490, and we do not know the depreciation. We are trying to figure this amount, and this equals to the closing balance. So closing balance was given to be 15,860. Since we are figuring the depreciation amount, I'm just going to shift this to other side. So that's going to be 18,500 minus 490 minus 15,860 equals to depreciation charge. So we can just calculate and figure the depreciation charge to be 2,150. So this is just the depreciation charge for this current year. So let's include that. Depreciation for the year on furnitures and equipment, or was it fixtures and equipment? So we figured the depreciation charge to be 2,150. So this concludes the total overheads. So the total overheads is going to be 3,070 plus 16,810 plus 3,240 plus 15,430 plus 2,150, which gives the amount to be 40,700. And since we need to subtract this overhead, I'm going to keep this in a bracket. Now we can just figure out the profit for the year. So in order to figure out the profit for the year, we'll start from the gross profit amount, right? So that's 52,760. Then we'll add the amount for other income, which is 1,260. And then we'll subtract the overheads amount of 40,700, which gives the profit for the year to be 13,320. So this concludes the income statement. Now we can move on to another question, fifth one. So we're given a lot of additional information, and we are required to calculate how much profit per annum will be made if Suin moves her business to the new location. Alright, so we need to consider all of these additional information in order to figure this out. So we're starting from revised gross profit. Let's look at the additional information. So the rent of the new shop premises will be 3 times the current annual charge. Annual sales could be increased by 10% on the figure for the year ended 31st July 2020, which means that what we had as a sales amount, we will add an extra 10% to that figure. And she intends to achieve a gross margin of 60%. So the total sales for the year and 60% of that total sales will be equal to the gross profit. And we are starting from revised gross profit, so let's start there. So we know that the annual sales will be increasing by 10%. So previous annual sales was of 96,000. So if we're increasing it, that's going to be 110%, which we can write as 1.10, right? And then the 60% of this amount is going to be the revised gross profit. So that's just into 60%, which we can write as 0.6. So this gives us the revised gross profit of 63,360. Alright, so we made use of this information and this information. Now, what we can do is consider the rent. So the rent of the new shop premises will be 3 times the current annual charge. So let's look at the annual charge. Shop rent was of 3,070, right? So that's going to be 3 times. So we just include the rent. And rent is an expense, so we will be needing to subtract this. So that's going to be 3,070 into 3, which gives us the total rent to be 9,210. And we are subtracting this in order to figure out the profit. Alright, so we made use of the first information as well. We're given that she will need to apply for a bank loan of 16,000 at 8% per annum interest to cover the costs of changing location. So we need to include this interest charge under the overhead, right? So let's calculate that first. So interest charge is going to be 8% of 16,000. So that's 16,000 into 8%, which we can write as 0.08. So this amount is going to be 1,280. And we will also need to subtract this amount because this falls under the overheads category, right? So we've made use of the fourth information. Then discount received will no longer be available. So other income section. Discount received is not available. And then profit on sale of equipment, it does not occur every year, right? So we can just completely overlook the other income section. There is not going to be any other incomes. Now for the overhead section, that's 40,700 for last year, and all of the expenses will remain unchanged. So the overheads is going to be the same. So other overheads is going to remain same, 40,700. But again, we've already included the rent amount right here, so we do not need to include it here, which means that we're going to subtract the rent amount. All right, so the other overheads is just going to be 37,630, again in a bracket because this is an overhead. We've made use of all 6 of the information, which means that we can just calculate the revised profit for the year. So that's going to be 63,360 minus 9,210 minus 1,280 minus 37,630. So that gives us the amount to be 15,240. That's going to be the revised profit. Previously, the profit was of 13,320. So the profit has definitely increased. So this concludes the 5th part. Let's move on to the final one, I guess. Okay. So advise Suyin whether or not she should change her business's location. Justify your answer considering both financial and non-financial factors. So let's consider the financial factor first. So what you know is that profit has increased. Profit has increased by, we just need to subtract the amount. So the current or the increased profit is 15,240. And the previous profit was 13,320. So the profit has increased by 1,920. Now, the increase in profit is not that big, right? So that's just the difference of maybe 2,000. So we can write that down as well. Increase in profit is not big. And what else can we write? We are given that she needs to take out a loan of 16,000 in order to change her business's location, right? So in order to take that loan amount, the business owner should have enough collateral to withdraw the loan, right? So Sui should have enough collateral to withdraw the loan. All right, so next factor could be that loan, there's no guarantee that the loan will be approved, right? So will the loan be approved? And the other factor is that will liquidity be affected due to the repayment of the loan? Because we're also given that the 16,000 will be paid over a 2-year period, right? So will the liquidity be affected due to the repayment of the loan? And what else is there? So all the other information that we were given correlating to the change in her business's location, those are just the forecasts, right? So there's no guarantee that the forecasts are accurate. So that can be another point. There is no guarantee that the forecasts are accurate. And if the forecasts are not accurate, then this increased profit of 1,920 is also not accurate. So maybe the increase in profit can be less than that. Maybe there will not be an increase in profit, right? There can be a decrease in profit as well, because those amounts are just forecasts. That's not the actual amount. Now we need to make a decision. We need to advise whether she should move her business or not. So considering all of the things that we just written down, I think that Suyin should not change her business's location. So that's going to be my decision. Suin should not be changing or not change her business's location. Alright, this concludes the sixth part, and this also concludes the first question in 2021 May-June paper 2-1. If you found this video useful, make sure you leave a like, you leave a comment below, and make sure you subscribe to the channel and hit the bell icon if you do not want to miss any other videos in the future. Thank you.